Picking the right world ETF to invest in is one of the most important decisions you'll ever make. The last thing you want is to constantly second guess your choice whenever a new ETF launches or something starts trending on Reddit. You want a fund you're happy to hold for decades, something that supports your long-term plan no matter what markets are doing in the short term. So today, let's go through what I believe are the best world ETFs for European investors right now. And I'll also share which one I would choose if I had to start from scratch in 2026. If you're new here, my name is Angelo, and I've been investing in low-cost ETFs for over 8 years together with my wife, following a simple buy and hold strategy. As I like to say, choosing an ETF is a lot like choosing a spouse. Ideally, you're making a long-term commitment, so you really want to get it right from the start. Because divorce is expensive, and so is selling ETF shares and paying capital gains tax early. Just like in a real relationship, you'll go through good times and bad times together. There will be years where your ETF makes you feel like a genius, and other times where it's down 20%, and you start questioning all your life choices. And much like dating, you want someone who is happy to travel the world with you, global diversification, doesn't spend all your money, low total expense ratio, has their life together, large fund size, and actually does what they say they'll do, closely tracking the index. Before we look at the ETFs, here's why I believe global diversification is still a powerful long-term approach. The truth is, none of us know which countries or regions will outperform over the next 20 or 30 years. Maybe the US continues leading. Maybe India takes a bigger role. Maybe the next Nvidia comes from somewhere we're not even watching right now. By investing globally and passively, you don't have to guess. You automatically own today's leading companies and tomorrow's success stories, no matter where they're based around the world. In my opinion, this is the simplest way to avoid regret and stick with your strategy long term, which is ultimately what matters most. It has certainly worked well for us the past 8+ years. Now that we covered the mindset, here are my ETF selection criteria. First, I want low ongoing fees, since differences in fees can add up over time. That being said, a tiny fee difference is not going to make or break your investment strategy. So don't obsess over this either if you like another ETF better. The ETF also needs to have a good tracking difference to its underlying index on average. Third, a solid fund size of 500 million euros or more to reduce the risk of our ETF shutting down during our holding period. I am only looking at physically replicating ETFs that actually hold the underlying stocks in the index, not synthetic swap-based ETFs. Fifth, no currency hedging, as that usually only adds unnecessary costs and tends to worsen the performance long term for globally diversified ETFs. Also, I'm focusing on accumulating ETFs since these are more tax efficient in most European countries, as they automatically reinvest dividends within the fund instead of paying them out in cash. I will still mention distributing versions as well for those of you that are interested though. And lastly, I don't want an ESG filter or other arbitrary ever-changing exclusions in my ETFs. I want to let the market decide. Alright, let's start with ETFs that cover only developed markets. So the US, Canada, most of Europe, Japan, Australia, and so on. With a developed markets ETF, your US exposure typically sits at around 70% based on current market cap, so about 10 percentage points higher compared to global ETFs that also include emerging markets. Just something to be aware of. Let's now look at 3 indexes and what I believe to be the best ETFs covering each of them right now. Starting with the most popular one, the MSCI World, which currently contains around 1,300 large and mid-cap stocks from 23 developed countries and covers 85% of the free float market cap in each of them. Based on the selection criteria I mentioned in the previous chapter, I would pick either of these 2 ETFs right now. The Spider MSCI World or the UBS Core MSCI World, which lowered its total expense ratio to only 0.06% 5 months ago. Because of its lower fees, I would probably give the edge to UBS right now, but I wouldn't be surprised to see a fee cut by Spider as well in the near future. iShares really needs to do something about its own MSCI World soon. A TER of 0.2% is just way too high in comparison now. And if you prefer having dividends paid out to your account twice a year, I would be looking at the distributing version of the same UBS ETF right now. By the way, I added all ETFs and their ticker symbols to the description below, where you can also find links to my favorite low-cost brokers in Europe to buy them, which is a great way to support me if you'd like to. Next up, we have the relatively new Solactive GBS Developed Markets Large and Mid Cap Index. What a mouthful. Why not just call it the Solactive World? It currently tracks the performance of 1,400 stocks in a large and mid-cap segment, covering 85% of the free float market cap in developed markets. As you can see, it's very similar to the MSCI World. Solactive simply uses a cheaper fixed fee pricing model for its licensing, which is why Amundi has been able to drive its fees so low with the Prime ETF series. I've covered this in more detail in another video you can watch here afterwards if you're interested. The Amundi Prime Global, priced at only 0.05% per year, is currently the only ETF covering this index, and it's available as either an accumulating or distributing version that pays out dividends once a year. And lastly, we have the FTSE Developed Index, once again covering large and mid-cap stocks in developed markets. At close to 2,000 stocks, it's significantly broader than the other two indexes, likely because it includes a few percent in companies which MSCI or Solactive would classify as small cap, as well as two more countries, South Korea and Poland, compared to the MSCI World. So if you want a slightly wider exposure to stocks from developed markets, the Vanguard FTSE Developed World is a great option to do that. There is also a distributing share class which pays out dividends quarterly. Alright, now let's look at truly global ETFs that also include emerging markets. By adding countries like China, India, Brazil, Taiwan and others, these ETFs give you exposure to fast-growing economies that could be market leaders in the future. Based on current market valuations, around 10% of your money is allocated to emerging markets when investing in a global ETF right now. That percentage could of course shift over time if those countries were to outperform. Once again, let's look at the main indexes for this category and which ETFs I would consider for each. Starting with the MSCI All Country World Index containing around 2,500 large and mid-cap companies from 23 developed and 24 emerging markets. Based on my criteria, here are the two ETFs from SPDR and iShares I would look at right now. Because of its lower fee and better tracking difference, especially since lowering the total expense ratio in August 2024, for me, the SPDR MSCI All Country World is a clear winner among these two. Next up, we have the Solactive GBS Global Markets, which currently tracks around 3,600 stocks in the large and mid-cap segment from both developed and emerging markets. Its main appeal is once again the low index licensing fee Solactive charges fund providers compared to FTSE or MSCI, which is why Amundi used this index for its Prime All Country World ETFs, priced at only 0.07% per year, below any other global ETFs at this point in time. Does this mean it's the best one though? We'll see later in the video. Just like with the Prime Global, here the distributing version pays out dividends once a year as well. And third, the FTSE All World Index, which covers around 4,300 large and mid-cap companies from 49 developed and emerging countries and adds a bit of small-cap exposure compared to the other two. It's once again the broadest of the three indexes, as FTSE tries to cover 90% of the free float market cap in each country, while MSCI and Solactive target 85%, so 5% less. Here we essentially have two ETFs battling it out, the popular Vanguard FTSE All World and Invesco's counterpart. And while it's great to see that Vanguard finally cut its fee recently, I'm still giving the edge to Invesco personally. Not only because its TER remains lower, but also because it performed better overall since its launch in 2023. It's actually the one ETF my wife and I have been buying since mid-2024, but more on that later. Now, if I was looking for a distributing version, I would still pick the one by Vanguard with its quarterly payments. And finally, we have by far the broadest index we're able to invest in via ETFs, the MSCI All Country World Investable Market Index, which is currently made up of over 8,200 large, mid and small cap companies from developed and emerging markets and covers 99% of publicly listed global equities. State Street, aka SPDR, is the only fund provider offering an ETF for this one, and I'd argue it's priced very competitively given how large of an index it's trying to track. If you want a global ETF that includes small cap stocks as well, roughly matching the real market weight of about 11% right now, then in my opinion the SPDR MSCI All Country World Investable Market ETF remains the best way to achieve that. Alright, after going through all the indexes and options, these are 7 world ETFs I would currently be looking at first for a lifelong buy and hold investment strategy. If you're looking for their distributing counterparts, you can find those in the description below. And if I had to start my investment journey from scratch in 2026, I would pick one of these two ETFs personally. The SPDR MSCI All Country World or the Invesco FTSE All World, as I prefer covering emerging markets as well. The main reason I'm personally giving the edge to Invesco is because I'm based in Austria, and so far it was significantly more tax efficient during the holding period based on its yearly reports. This is only relevant if you're based in Austria though, so if I was living anywhere else, I'd be just as happy grabbing the SPDR ETF. You can find all ETFs on my favorite broker, Interactive Brokers, linked down below if you'd like to support me, where I also have a recurring investment for the Invesco FTSE All World running at the start of each month. Now, you probably noticed I didn't pick either of the two Amundi ETFs, even though they clearly have the lowest fees in their respective categories. So let me quickly explain why. While I give Amundi a lot of credit for pushing fees so low, forcing the competition to do the same over time, I am still hesitant to buy any of their ETFs personally because of their recent history regarding fund mergers and ESG conversions nobody asked for. While I do believe that has become less likely for the Prime Global and Prime All Country World due to how large they've grown in size, I think there's still a small risk they might specifically exclude more companies that are present in the underlying index or convert it to an ESG version down the line, because they're already doing that today to an extent. For example, Lockheed Martin, the 164th largest stock in the world, is included in all ETFs I mentioned today, except for the two Amundi Prime ETFs, even though it's present in both underlying Solactive indexes. To find out why, you have to dig deep into Amundi's prospectus, where you'll see that they're filtering out some companies on purpose. Who is to say they won't exclude more stocks further down the line because they, or France, the country they're based in, doesn't agree with certain views? I simply want to passively buy and hold the entire market over decades. I don't want anyone interfering with what stocks are included or excluded based on ever-changing opinions on what the world should look like. This is just my personal opinion though. You are free to do things differently. I prefer waiting and observing these Amundi ETFs for a few years before I consider adding them to my own portfolio. After all, we're talking about ETF shares that we'd like to hold for decades, ideally forever. Before we wrap up, please make sure you don't make this one major mistake. If you already own another world ETF that's currently in profit and that's still in line with your long-term investment strategy, don't sell it to switch to a new ETF, for example, if you discovered one you like better today. Hold on to it instead until you actually need the money, for example in retirement. My wife and I are doing the same with our existing X-Trackers MSCI World and Vanguard FTSE All World shares we've accumulated over the past 8 years. Having to pay capital gains taxes early by selling would far outweigh any small yearly difference in fees. So instead, we simply direct all new investments into our global ETF of choice, the Invesco FTSE All World, while holding on to our old shares. And there's nothing wrong with you sticking to your current ETF either if that's your preference. I only wanted to inform you of what's out there right now. My goal with this video was certainly not to persuade you to change anything. Are you following a one ETF strategy as well? And which ETF would you pick if you had to start over in 2026? I'd love to know in the comments. If you want to know how to use Interactive Brokers effectively and pay the lowest possible fee whenever you buy an ETF, make sure you watch this video next. Don't forget that none of what I mentioned was meant as investment advice. I'm just openly sharing my personal opinion as an investor. Thank you guys so much for watching. Have a wonderful day and until next time.